Good morning. Our lecture today is about the rule and the environment of managerial finance. Last time we talked about what's finance and we define finance as the art and science of managing money. So finance is concerned with the process, institutions, markets, and instruments involved in the transfer of money among individual, business, and government. So it is related management of money, so it's concerned with process, institutions, markets, and instruments involved in the transfer of money among individuals, businesses, and governments. What are the financial services? Financial services is the area of finance concerned with the design and the delivery of advice and financial products to individuals, businesses, and governments. What's managerial finance? Managerial finance is concerned with the duties of the financial manager. In the business firm. So financial manager manages the financial affairs of any type of business. Manages the financial affairs of any type of business, whether this business is public or private, large or small, profit seeking or not profit seeking. So it's for all types of business. Also, financial managers involved in developing corporate strategy and improving firm's competitive position or the ability to compete in the market. Legal forms of business organization. There are three main legal forms of business organization. They are sole proprietorship, partnership, and corporation. With respect to sole proprietorship, it's owned by only one individual. With respect to partnership, it's owned by two or three or few number of partners. And finally, with respect to corporation, it's owned by large number of owners, which are shareholders. What's the points of strengths and weaknesses of each one of them? Point of strength: number one, owner receives all profits. And if there is loss, owner sustains all losses. Number two, low organizational cost. Number three, income earned from sole proprietorship is taxed based on personal tax rate, not corporate tax rate. Number four, independence. Number five, ease of dissolution. What about partnership? Number one, can raise more funds than sole proprietorship. Number 2, borrowing power enhanced by more owners. Number 3, more available brain power and managerial skills. And finally, number 4, income included are taxed based on personal tax. What about corporation? Number 1, owners have limited liability. Which guarantees that they can't lose more than they invested. So their loss in this case will be equivalent to their investment. Number 2, can achieve large size via sale of ownership. Sale of ownership, which means sale of a stock. Number 3, ownership is transferable. Number 4, long life of firm. Number 5, can hire professional managers. Number 6, has better access to financing. And finally, number 7, can offer attractive retirement plans. So these are points of strength of sole proprietorship, partnership, and corporations. What about points of weaknesses? Number 1, with respect to sole proprietorship, is owner has unlimited liability. So this means their loss can be extended more than their investment. Number 2, limited fundraising power, which will affect the growth of the company. Number 3, difficult to give employees long-run career opportunity. And finally, number 4, legs continuity. When the owner dies, so the firm should be shut down immediately. What about partnership? Number 1, owners have unlimited liability, just like sole proprietorship. Number 2, partnership is dissolved when a partner dies. Finally, number 3, difficulty to liquidate or transfer partnership. What about corporation? Number 1, tax rates are usually higher than sole proprietorship or partnership, as the tax rate that's applied in this case is corporate income tax. Number 2, more expensive to organize than partnership or sole proprietorship. Number 3, subject to greater government regulations. Number 4, lake secrecy, as stockholders must receive financial reports. So these are the main points of weaknesses for the 3 different types of firms: sole proprietorship, partnership, and corporations. Corporate organization. Stockholders are going to elect the board of directors. Board of directors will hire the president or the CEO. CEO will hire a number of managers or vice presidents in terms of human resource, manufacturing, finance, marketing, and information resources. So this can be classified as these parts. The upper part is related to the owners, and the lower one is related to managers. With respect to finance or vice president of finance, he is going to hire treasurer and controller. What is the main functions of each one of them? Or each one of them will be responsible for number of managers. With respect to the treasurer, he is going to be responsible for 6 main managers. They are financial planning and fundraising, number 2, capital expenditure, number 3, cash manager, number 4, credit manager, number 5, pension funds manager, and finally foreign exchange manager. While with respect to controller, there are 4 main types of managers. They are corporate accounting manager, tax manager, financial accounting manager, and finally cost accounting manager. So this is the structure of the corporate. The upper part, which is a board of director, is elected, while with respect to lower part is hired. Actually, the size and the importance of managerial finance function, depends on the size of the firm. So with respect to small companies, all functions can be performed by only one individual, which is the company president or accounting department, while if it is a large company, they have to be distributed between different managers or employees. What is the relationship between the managerial finance function and economics? Actually, finance sometimes referred to as financial economics. Financial managers must understand the economic framework within which they operate in order to react or anticipate to changes in condition. So finance can be referred to as financial economics. Financial managers must understand the economic framework, as this will affect their decision in different situations. So the primary economic principle that's going to be used by financial manager is marginal cost benefit analysis. Actually, the word marginal means additional. So this means if you would like to increase your investment by additional pound, or increase production by additional unit, increase consumption by additional unit, so it's any additional value. Okay, so marginal cost, what is the additional cost that you have to pay to increase investment, or to eat one more unit of a product, or even to produce one additional unit of any commodity. And with respect to marginal benefit, so this is related to the gain that you are going to get from this additional unit. So investment decision or financial decision should be implemented only when marginal benefit or additional benefit exceeds marginal cost. So in this case, we have to take the financial decision. Otherwise, when marginal benefit equals marginal cost, so this is the point of maximum profit. So we don't have to increase our investment, or to increase our borrowing, anything related to that. This is the ideal situation, so we don't have to move it from this point anymore. Okay. Relationship between managerial finance and accounting. One of the main differences between accounting and finance is that accountants use the accrual method, while finance use the cash flow method. This is point number one. What's the difference between accrual and cash flow? Let's illustrate this using an example. Say, for example, ABC Corporation experienced the following activity last year. Sales, $100,000. It's 100% still uncollected. And costs $80,000 fully paid. So what is the difference between accrual and cash? In case of accrual, sales will be 100,000 and cost will be $80,000. So net profit or loss will be $20,000. This is based on accrual base. While with respect to cash, actually there is no cash collected from the sales. It's 100% still uncollected, so it is $0. And costs, which is $80,000. So the net profit or loss is $80,000. So this is the cash basis which is gonna be used by the finance side, and this is the accrual base which will be used by the accountant side. Number two, this is point number one. Point number two is related to decision making. Accountants used the data for presentation. Just they would like to make a presentation for this financial data. Without taking any decision. While with respect to finance, financial data will be analyzed and interpreted in order to help to make decision. So the primary activity of financial managers is related to the balance sheet of the company. As we know that the company's balance sheet is classified into asset side and liability side. This is current assets and fixed assets. And with respect to liability side, is current liabilities and long-term fund. This side is related to making investment decision. And the liability side is related to making financing decision. So this means that the financial manager has to make two main decisions. Number one, investment decision, and number two, financing decision. When we are going to talk about a corporation or corporate finance, what is the main objective of firm manager? Usually firms would like to maximize profit, but in case of corporation we are not going to talk about maximization of profit, but mainly about maximization of shareholders' wealth. As in case of corporation, the matter is matter of cash flow, timing of this cash flow, and risk of this cash flow. So the main goal is not related to profit maximization. Goal is related to maximizing shareholders' wealth. Why? As shareholders' wealth will be affected by cash flows, timing of these flows, and risks of these cash flows. So this means that the financial manager have to take a financial decision or to study different financial alternatives, and in this case he has to study the return and risk of each alternative, and then if this alternative is going to increase share price, so yes, take the action and accept this decision. If no, so it is rejected. So this means that financial manager has to study risk and return associated with any financial decision, and the main objective in this case is to increase share price. If this goal is achieved, accept the decision. If we couldn't achieve this goal, so reject this decision and think about any other alternative. In some cases, we have an agency problem. What's meant by agency problem or agency issue? Agency problem as we said that we have shareholders and managers. What ought to be is that shareholders and managers have the same objective, which is maximization of shareholders' wealth. So this is the main objective here. And it should be the objective of the manager. But in case of agency problem, there is a conflict of interest, or managers would like to seek their own objective. Say, for example, job security, lifestyle, fringe benefit, personal wealth. They are concerned with these points. Okay, so they are not going to focus on maximizing shareholders' wealth. So this is the idea of agency problem, which is conflict of interest or conflict of objectives between the shareholders and managers. If there is a problem of agency problem, how can we manage it? Or how can we overcome this problem? Number one, Monitoring. Owners of the firm or shareholders must monitor actions taken by the managers in order to make sure that they are going to achieve the main objective of the shareholders, which is maximizing shareholders' wealth. Number 2, compensation plan. Such as profit share or any incentives that can be provided for the managers. Number 3, stock option. In this case, the managers are going to be partners or shareholders as well. So in this case, they would like to achieve their own objective at the same time. Stock option is an incentive allowing managers to purchase stock at the market price set at the time of the grant. So these actions will help to monitor or to avoid the problem of conflict of interest of the manager and the shareholders. This is the end of our lecture today. Thank you and see you next lecture.